Life insurance. If you're like me and you're someone who likes to make sure that you have all of your bases covered, it's important to understand your life insurance needs and how it can help you take care of your loved ones in the event that you're no longer here. I'm Sian, and in this video, I'll walk you through a beginner's guide to life insurance and everything that you need to know in order to buy it. Let's get started. First question, what is life insurance and how does it work? Life insurance is something that you buy so that in the event that you die, someone that you designate will receive a lump sum of money. Why would you need something like this? Well, you may have a financial stream of income that you have loved ones who depend on. Maybe you have children and you provide for them in the household. Maybe you have a partner and the two of you share responsibilities for a mortgage or for other financial obligations. The point being, if your disappearance from this planet and the disappearance of your income would cause financial strain for people who depend on you, life insurance may be something that you want to help cover that eventuality. Life insurance is insurance. It's something that you buy for peace of mind, for an event that you hope won't happen, but if it does, you want to make sure that certain situations are taken care of. If you're in a position where you already have enough assets or enough wealth to take care of your loved ones in the case of your death, or if you don't have people who depend on your income or your finances, then you may not need life insurance. But for those of you who do, let's talk about a few important terms and what they mean. First term, beneficiary. Beneficiary, of which there can be multiple, is the person or people that you as the policyholder specify or designate to be the people who will receive the lump sum of money in the event of death. Typically, this would be someone like your spouse or partner, your children if you have them, or perhaps your parents. The premium is the payments that you make to cover the cost of the life insurance. These are typically made on a monthly, quarterly, or annual basis. You make these premium payments over the life of the policy and as long as you choose to continue to have the policy be active. Death benefit. This is the total amount of money that the beneficiaries will receive in the event of death. This is typically a tax-free amount. How does this all work? Let's take an example. You purchase a 30-year, $1 million policy where you designate your spouse as the beneficiary. In this case, the $1 million policy refers to the $1 million death benefit, and the beneficiary that you, the policyholder, have selected is your spouse. For this policy, the monthly premium is $50. So for 30 years, every month, you, the policyholder, pay $50 to the insurance company to keep the policy active. If before the 30 years are up, you, the policyholder, pass away, then your spouse, the beneficiary, will receive the death benefit of $1 million. If not, after the 30 years pass, the policy expires, or if before the 30 years are up, you choose to stop paying the premiums and the policy is no longer active, that would also be a way that the policy does not pay out or is no longer active. Now that we've covered a couple of examples, let's zoom out for a second and talk about the difference between term life insurance and whole life insurance. Term life insurance is what I'm spending the bulk of this video discussing and are the examples that I'm using. Term life insurance is something that is in effect for a specific period of time or a set term. It has a beginning date and an end date at which point the policy expires. So as a policyholder, you choose a set period of time for which you know that you need insurance and you insure yourself for that period of time. After the time is over, you no longer need insurance and no longer have insurance. Whole life insurance, which can also be referred to as permanent life insurance or universal life insurance, does not expire. It also has a cash value component, which acts somewhat like an investment account which you can borrow from. The key differences here, though, are that whole life insurance is significantly more expensive than term life insurance, often in the range of 10 times more expensive for the same death benefit. For the vast majority of people, you are much better off sticking with term life insurance. The incremental benefit of that cash value benefit that whole life insurance offers is almost never worth the additional premium that you have to pay, that 10 times more expensive premium that I mentioned when comparing whole life insurance to term life insurance. Most of the time, you are far better off simply buying the term life insurance and taking the difference and investing it yourself. Keep in mind that you may run into advisors or financial or insurance salesmen who try to sell you whole life insurance, and it tends to be oversold because many financial advisors or insurance salesmen stand to make very high commissions off of selling you whole life insurance. But it doesn't necessarily mean that it's the right product for your own needs. Now that we understand at a high level how life insurance works, we'll move into the second key question, which is how much life insurance do I need? How much do you actually need to buy and for how long? There's a few different ways to think about this number and calculate what your needs are, and we can lay out a couple of different examples to help you get to what that might look like for yourself. One approach is a simple one that's referred to as 10 times income. All you do is you take the gross income that you make today, the salary that you earn from your job, multiply it by 10, and that's the amount of death benefit that you need. So for example, if you are someone who is earning a $70,000 income, multiply by 10 to get $700,000 as the life insurance policy size that would be appropriate for you to purchase. The second approach is a bit more granular. Add up all the specific financial needs that you want to be able to cover. As an example, perhaps you want to be able to pay off your mortgage, which costs $300,000, pay for your kids' college education, which will need $200,000 for, plus have another $100,000 set aside for incidentals for your spouse or anything else that needs to be covered, adding up to $600,000. The third approach is what I like to call the financial independence number minus existing assets. In the personal finance world, some people often use what's called the 4% withdrawal rate rule to determine their financial independence number. Let's say that your family's lifestyle costs $40,000 a year to support. In this case, $40,000 is 4% of $1 million. So in this case, theoretically, $1 million can support a withdrawal of $40,000 every year for the rest of your family's lifetime. If you need $1 million and your family already has existing assets of $300,000, 1 million minus 300,000 is 700,000, and you could obtain a life insurance policy for that $700,000. Let's talk about a few examples of who does and doesn't need insurance. Case study 1. 35-year-old Hannah is married and has 2 children. She and her spouse have a mortgage that they pay together and 2 mouths to feed in their household. If Hannah were to pass away and her income were to disappear, that would have a drastic effect on the household's ability to continue paying the mortgage and continue living the lifestyle that they do today. Even if Hannah was a stay-at-home homemaker and did not earn a distinct salary, that still may be a reason to obtain a life insurance policy, because without her there, her spouse would have to get childcare for the children, which costs money that Hannah is providing value in today. So in this scenario, with these types of financial dependence and financial obligations that are shared between the 2 adults, there are life insurance needs to be considered. Case study B. 25-year-old Shruti is single and she lives by herself in the city. Her parents are financially stable. They don't rely on her for any financial needs. She doesn't have anybody else who she needs to support. Shruti is probably fine on her own, being able to navigate life without worrying about the financial needs that she would leave behind that other people depend on her for. She may not need life insurance at this point in time. Case study C. 50-year-old Tim is single and the primary caretaker for his aging parents who depend on him financially. However, he's also accumulated over $2 million in assets over the course of his working career, and he would be able to leave all of that money to his parents if he were to pass away before them. Depending on the cost of care for his parents, Tim may or may not need more assets in addition to that $2 million he already has, and so he could consider, by calculating those costs, whether he still needs to take out a separate life insurance policy. One tactic I'd like to bring up is what's commonly called the laddering technique. This is a way of using multiple policies instead of just one to achieve your goals and your needs with a bit more flexibility. Oftentimes, you have different amounts of life insurance needs at different points in your life. Like at one point, you may just have a mortgage. At another point, you also have children and an education that you want to pay for. And with those changes over the course of your life, it may be beneficial to have multiple policies with different time horizons and different death benefits to be able to achieve exactly the profile that you need. As an example, let's say your family has a mortgage with 10 years left to pay on it and a remaining balance of $300,000. You also have 2 young children who would plan to start college in about 15 years, and you want to be able to cover for their education. You could take out 2 separate policies to help you meet these needs. One, take out a 10-year policy with a $300,000 benefit so that if you were to pass before the mortgage is paid off, the death benefit would kick in to help cover the rest of that mortgage balance. 2, you could take out a 20-year policy for $200,000, or whatever amount you believe that you need to afford your children's college education. These 2 policies combined can help you meet the slightly different needs with different timings of exactly what it is you want to make sure is covered in the event that you're gone. Last section. How do you buy a life insurance policy? Keep in mind that life insurance is essentially a commodity. The product does not change very much from company to company, if at all. So the guidance here is very clear. Buy a cheap policy from a reasonably reputable company. You want to find a reasonably reputable company because you don't want to be worried or anxious that the company you purchase from might go bankrupt overnight or disappear before it has the chance to make good on your policy. It's not something that you need to overly stress out about, because even if that were to happen for most companies, they would likely get purchased by a larger company who would assume the same obligations. But something you can do is Google the financial strength ratings of different companies that you're considering to make sure that it passes a reasonable bar. Once that threshold is met, pretty much look at all the options and pick the cheapest one. Life insurance is really very simple, and the product itself is very much a commodity. This is very different from, let's say, car insurance, where there's a lot of ambiguity and nuance in what it is happening when you are making a claim. And it's possible for a car insurance company to fight back with you and say that this crash was this person's fault, or this person's fault, or this part of your collision damage and your windshield being damaged is within their scope of responsibility versus not. When it comes to life insurance, on the other hand, it's very much a black or white distinction. Once the policy holder has passed, somebody, usually the beneficiary, can simply file a death certificate. That proves that the policy holder did pass away, and if the policy is active, the company pays out. It's very simple. There are not many lines to be able to argue or negotiate, and that's why these types of policies don't differentiate themselves from company to company, and it's really just in your best interests to find the cheapest one. And when I say cheapest, I mean the lowest premium for the same amount of death benefit. So if you're looking for a life insurance policy with a $1 million death benefit, perhaps you compare 5 different companies, and on the cheapest end, one offers you the $1 million 30-year policy for $50 a month, and on the more expensive end, there's a company that would charge you $85 a month for the exact same policy, $1 million benefit over the course of 30 years. All else being equal, you should choose the company with the cheapest premium, the $50 a month. Because it's helpful to be able to compare options, I suggest looking for an online insurance marketplace that can help you to lay out many different options out there and compare easily. Personally, I've used sites like Policy Genius, which I found helpful to be able to easily input some initial information and get many different quotes easily. You could also use an independent insurance agent who has the ability to sit down with you and walk you through multiple different options that they are not directly affiliated with. That sums up the basics on what you need to know about life insurance and how to buy it. I hope you found it helpful. For more videos like this about how to make the most of your money, be sure to hit subscribe. Thank you for watching, and I'll see you in the next video.